Everybody, I'm John from Folla Capital, and we're just thrilled to have you here on yet another informative online event that we have with one of our issuers, Avery Washington from Management Continental Ground. How you doing today, Avery?
I'm doing well. Thanks for asking. How are you, John?
I'm doing great. Looking great as ever, Avery. You always outdo me, man. I got to get one of them sport coats. But anyway, we're also here with Dale Weingarten from Alto, one of our partners. And how you doing today, Dale?
I'm doing well. Thank you for asking. Excited to be here.
Yeah, thanks. Appreciate you joining us today. First time we've had you guys on one of our events, and just appreciate you being here and sharing some of the stuff you're going to share. Anyway, thanks for making it. If you're here live, you can see our bios on the left, and you can click on that, and it's our contact information, a little bit about us. There's also a resource list there with an ebook from Management Continental Ground, as well as links to Alto's website, their fee structure, a link to our website with current campaigns. And if you're watching the YouTube version of this, there'll be links to this in the description as well. And if you're live, you can actually change the size of your slide area there, play around with the interface, and you won't screw it up for anybody. But anyway, without any further ado, let's get right into it. Standard disclaimer, folks, we're going to talk about investment opportunities here. If you would, please take a moment and read this slide. In general, we might refer to forecasts or certain elements about the capital raise that we're conducting and facilitating for Management Continental Ground. And the bottom line is go to the website, review all the documents and disclosures that are represented in the offering package on our website that we'll refer to before you consider making an investment decision if that's what you're interested in doing. Just a disclaimer that we'll refer to some of that in our comments today. Here's what our offering site looks like in the case of Management Continental Ground. You're not seeing double there. You're seeing two offerings because what we're doing with Management Continental Ground is called a side-by-side offering. And what we're doing there is one offering is for accredited investors and one offering is for everybody else, non-accredited investors. The latter being a Reg CF and the accredited investor one being a Reg D 506C. Because the way the rules work, we can do that side by side, and Avery's chosen to do that so we can invite any investor and any number of investors into the project that he'll be talking about today. Just real quick, why would anybody want to do that? I love this image because it sets some good groundwork for what we're going to talk about today. So what you're looking at here is a net worth profiles of U.S. households. So the top row there is a net worth in a household of $10,000. Basically, you're probably below the poverty level if you're in this top row. And what you see there is visually how the net worth breaks down. If you actually own a home with that kind of net worth, that's probably the bulk of your net worth, followed by how much your car's worth and what kind of equity you have in your car. And then coming in third is retirement funds. Most American households are actually on the second level. And if you look at that profile, you know, some ability to save for retirement and some retirement funds come in second there. There's a flip-flop with the vehicles. But again, the primary home tends to be the largest driver of wealth creation in most U.S. households at net worths, as you see here. But what's interesting is what happens as that net worth profile grows. So the third level is a net worth of $1 million, which generally by definition allows that household to cross the threshold of being an accredited investor. There's more to the definition than just that, but just generally speaking, $1 million in net worth gets you there. And what is a difference in what the drivers of that net worth are as you go up down to Elon Musk there at the bottom. And when you look at most of the wealthiest people in the world, their wealth was driven largely by their investments in private businesses and business investments, as well as coming in second, real estate investments. And what we're going to talk about today is a little bit tied to this reality. We're going to have an open discussion about how all of us can start thinking about where to put our money into different categories. And then because of recent law changes, we don't have to be very wealthy anymore to participate in many of these, and I'll leave it at that. Just for a fact check here, throughout history, any non-accredited investor could participate in some limited private investments in private businesses. It's not that it's the first time we can all do that. Throughout history, we've been able to do that, but with some recent changes in the law, particularly one called Reg CF, which is being offered in this case, now many of us can participate in an offering that offers a Reg CF offering as part of it, like Management Continental Ground is doing. So I thought this would be interesting to set the stage. And the first time I saw this, I was a little baffled by it, but it's an amazing eye opener when you look at how we think about differently about money, depending on where we come from, how we grew up, what kind of household we grew up in, and how we were taught about money and what to do with money over time. It's pretty astonishing. So I'll just leave it at that. So with that as a backdrop, Avery, I'm going to turn it over to you to tell us a little bit about what you're up to.
All right. Thank you, John. I appreciate it. So I'm Avery Washington. I'm the manager of Continental Ground, and we're just going to start out with the typical disclaimer. So I'm going to lay out some concepts and ideas that I've put into practice. However, you definitely should consult with the relevant professionals and licensed and credentialed people in those industries before you go out and do them. All right. This is me, Avery Washington. So originally from Connecticut, now in North Carolina by way of the Marines. And over my career as a real estate investor, which started in 2013, I've raised over 1.9 million. And for now, with an average annual return of 17%, but that'll be going up shortly, which we'll get into later. Spent 12 years in the Marines and currently have managed the acquisition of over 6.5 million in assets with the portfolio I currently manage. And I'm involved in the development of well over 500 units of housing throughout North Carolina. And I started doing that in 2021. These are some of the companies that I work with in the process of development, or the development team. They are throughout North Carolina, from central to eastern North Carolina. These are just some of my business goals. Some of them have some overlap with some of the things I currently have going on, but a lot of them are future goals. And then lastly, this is a big part of the reason why we're here today, right? Alternative investment benefits, learning about different ways to set aside money, save money, store your nest egg, and also opportunities or ways that you can invest it. We're used to the idea that you either put it under the mattress or in a shoebox, or you leave it in a bank. But when you put it in a bank, banks use your money to invest in assets and lend money to other people and generate interest off of it. And I have a belief that we could maybe skip the middleman and you get more for the money that's already getting put to the same use directly with the people who enact processes that create value and help grow it. As a developer, these are specifically the 3 ways that I make you money. I focus on 3 phases of development. Shovel-ready sites, which is me taking vacant land, completing all the engineering, permits, and entitlements needed for someone to start civil construction. The next is build-ready, me taking that shovel-ready site and creating finished lots, which is essentially a neighborhood with no homes. That's what I refer to as build-ready. And then lastly, the term I made up is move-in ready, the part that everybody wants, a house and a roof over top, vertical construction, which typically the biggest names that you recognize across the country are who are more associated with a move-in ready product, the most popular builders. Funding options, and this ties into the ebook that brings you here today. It's not uncommon to have cash on hand in banks, but Dale's going to speak more about retirement accounts, specifically self-directed retirement products, which is something less commonly known about. There are also life insurance policies with cash values that can be utilized, or money market accounts, as in accounts with the stock market where either people in some cases liquidate the stock they have or they utilize the stock they have to get loans to make investments or purchases as needed. And here's my contact information. If you're already on your phone and you can't scan this, then you can just note or take a screen grab of what's up there. But if not, if you scan that QR code, it'll not only take you to the website, social media, the easiest ways to communicate with me, however suits you best. And with that, I'll turn it over to Dale.
All right.
Hey, Avery, if I can call an audible, guys, I got a couple of questions for you, Avery. Make more sense to talk about them now before we transition to Dale. But talk about the current project that we're raising capital for in the context of what you just said, with generally how we got those three phases. Can you just speak to the current project a little bit more?
Definitely. I consider as you go into each phase of development, you're taking on additional risk or expense in the project. I've designed this offering to mitigate risk essentially twice over. One, by having the raise cover 3 different sites in 3 different submarkets of North Carolina. And two, each site exits in a different phase of development. And then lastly, the further it goes into the phases of development, the smaller the site is. So there's a 13-acre site, which will end up being an 18 single-family home neighborhood, a 28-acre site, which will be delivered as finished lots to a national builder who we're already engaged with selling the finished lots to. And then lastly, a shovel-ready site that's 100 acres, and that will be sold fully engineered and entitled actually to 3 different end buyers: a commercial, a multifamily, and a residential builder. And I wanted to create something that allowed non-accredited and accredited investors to participate and create a forum for people to learn more about what I'm doing, because you should invest in anything you don't understand. So I have to be willing to help you understand it without trying to get you to buy something from me first. And two, I have to be able to create a reasonable barrier to entry as well, an amount of money for investing that someone can reasonably set aside over time and invest and grow.
That's cool. So just to reiterate, because I'm aware of the project, so you've got 3 geographically separate development efforts that map to each of those 3 stages of development. Is that correct?
Correct. Mm-hmm.
Yeah, that's awesome. And the fact that you're inviting people in to participate in this real estate development effort is pretty cool. Other question I have for you is, this isn't your first rodeo, right? Like, you've done something like this before with a previous raise, and full disclosure, we helped you with that raise. But can you talk a little bit about that prior raise we did?
Absolutely. So previously, I did a 506B raise, which means I have to have an existing relationship with all the investors. I can't publicly market it. We are actually on the tail end of the project to get sold to a developer who's going to do all the horizontal site work or civil construction and then deliver finished lots to a national builder. And it's going to be finishing a little over a year early, at least. So really excited about that. I'll be getting a handful of investors back their money much sooner than they expected. So looking forward to getting that one in the books.
Yeah, and I applaud you for that. We were with you every step of the way there, so it's nice to see that come full circle. So this time, instead of doing a Reg D 506B, which was invitation only, you can advertise. We're doing this side by side, so now we can advertise. Hence this webinar and some social media to attract some investors. So that's just for the audience. That's the big difference here, and I think that was intentional, right, Avery? You want to invite more people into the process. Is that correct?
Absolutely. I think that it's easier to raise a lot of money faster from less people with larger amounts of money. I don't think that makes it right to only do that. I think there are a lot of people that would love the opportunity to learn how to grow their nest egg, to learn about different ways they can invest their money, that don't necessarily have 50 grand, 100 grand laying around. And to me, it makes perfect sense to facilitate them having the opportunity to participate in these types of things.
Yeah, we're seeing that more and more in the investment industry, that you don't have to be the wealthy person who writes large check for real estate development efforts anymore. You can invite a lot of smaller investors into projects now because of the securities laws, the internet, and the ability to structure things legally and cast a wide net, which is what you're doing. So I applaud you for that.
Thank you.
Hey, hey, last question I have for you before we move on to Dale. I do know firsthand, because I helped you with this, a big part of the long-term objective with this project, it has to do with affordable housing, right? Can you just touch on how you're trying to address this issue of affordable housing with the
Absolutely.
project?
So, a trend that I notice and I can understand is it's really difficult to make a home product at a price point that actually is affordable. And in part, that's because the cost of labor, materials, land, it's hard to make a home that with the interest rates currently can be afforded by the average buyer. So what I wanted to do was come up with something where you have the developer involved in the creation of the home, from the vacant land where it's just a bunch of trees all the way through the creation of the house. So that way you can spread the margin across the entirety of the project, instead of how I explained in the project that's about to close out. What typically happens is someone like me will create a shovel ready site, they will sell it, then that's sold at an increased margin. Then someone will purchase it, they will do the civil construction, and they'll sell finished lots, right? There's a new margin. And then the builder will also tack a margin on top of it and build the house, which they obviously make it a profit. So each of those phases also comes with increased cost to the end user. So I wanted to eliminate as many buyers in that process in order to create the most cost effective product that I could put out onto the market.
Yeah, I think that's pretty cool. That's why I asked the question, because you schooled me on that when we were developing this offering, and I think that's pretty neat and worth mentioning. So hats off to you
Thanks.
for trying to be innovative there.
Good.
Avery, anything else you want to add about the project or anything else before we move on to Dale?
One last thing. My goal is the next raise that I do, it will probably be Reg A. And the goal will be to have a single offering with a low minimum that allows anyone capable of that minimum to invest, but everyone gets the same terms. And the target is going to be double digit returns. So that's my social contract that I'm creating.
Good, good. Keep raising the bar, man. But wish you luck, and thanks for all that background. Appreciate it.
Thank you.
Um, Hey, so we're going to transition now. As Avery mentioned, there are in his comments, there are different ways to use different sources of funding for these types of investments. And one of them is to use a self-directed IRA. And in our world at Folla Capital, many of the investors that have invested in our deals have elected to choose this option. And I won't steal any thunder from Dale, but Dale's going to touch on that. Dale's from Alto, our partner, when it comes to involving self-directed IRA options for our investors. So with that, Dale, I'm going to turn it over to you, and you can tell us a little bit about that.
Awesome. Thanks again so much for having me. Quick disclaimer before jumping in. Alto solely acts as a self-directed IRA custodian. None of the information that we provide constitutes financial, tax, legal, or investment advice. We are solely viewed as the custodian in order to make any investments through a self-directed IRA. So with that being said, as a brief agenda, some of the things that we'll cover: retirement accounts in general, IRAs specifically. We'll get into the niche of self-directed IRAs. From there, we'll transition a little bit more into Alto's origin story, how to invest with a self-directed IRA, and then some real life examples of different people who've utilized the self-directed IRA effectively. Looking at this chart, one of the things that's really interesting that really jumps out, this chart is essentially just the breakdown of different retirement accounts by dollars that are aggregated within them. What's really surprising to me, especially, is just that 401ks are viewed as the king retirement account. Everyone considers their retirement account the 401k. When you look at the IRA, you can see on this graph, more than $4 trillion more are held within IRA accounts than within 401k accounts. This comes from a number of reasons, primarily optionality that you have within an IRA that you don't have within a 401k. So most people don't realize that they're able to roll a 401k from a previous employer into an IRA. What that does is that gives you more control of what you're actually able to invest in. So anything from individual stocks, bonds, ETFs, all the way to some alternative investments like real estate, private equity, venture capital, and a whole list of other things that we'll also touch on throughout the presentation. All these numbers are accurate as of Q1 2024. Jumping into the distinction of the different types of IRAs, there's 3 types, and I'll start a little bit out of order on this slide. The SEP IRA, so starting all the way over on the right, is primarily for self-employed individuals. Income is taxed on withdrawals, so in that sense, it's treated very much like a traditional IRA, where all the funds that are coming in are pre-tax, but they're able to grow pre-tax until you actually take a distribution out from the IRA. Where it's a little bit different than a traditional is that you're actually able to contribute much more into a SEP IRA than you are into a traditional or a Roth. So the contribution limit for 2024 was $69,000 or 25% of your income, and it was the lesser of those two numbers. For 2025, it's actually $70,000 is the IRA contribution limit for a SEP IRA, or again, the lesser of 25% of your income. Jumping back over to the left is a traditional IRA, which is similar in the aspect that it's a pre-tax IRA. All the funds that are contributed are pre-tax dollars. They're growing without any capital gains taxes paid on them, so long as you're adhering to IRS rules and guidelines. And then you're taxed on distributions that you're taking from the IRA once you're either over age 59 and a half, or once you start taking required minimum distributions from the IRA. The contribution limit for both traditional and Roth IRAs is $7,000 if you're under the age of 50, or $8,000 if you're age 50 or older. And then lastly, the Roth IRA, same contribution limits. What's really unique about the Roth is that it's all funded with after-tax dollars, so that everything that you're investing is growing and will never be taxable so long as you're not taking an early distribution before the age of 59 and a half, or doing anything that the IRS would consider to be prohibited. With the Roth, there is some limit to the amount that you're able to contribute if you earn over a certain income threshold. That threshold was $160,000 in 2024. We're ineligible to contribute to a Roth. But what most investors are able to do is convert traditional or SEP funds into Roth funds through a Roth conversion, which enables you to invest those dollars as post-tax dollars within the retirement account. We don't advise if that's the right decision for any investors, but we do just try to educate investors that the Roth conversion typically is an option if it makes sense for people to consider that. So getting into self-directed IRAs more specifically, and why they're not more popular for alternative investments, where the main distinction with a self-directed IRA and an IRA is that a self-directed IRA actually allows you to invest in alternatives that you can't find within a standard brokerage account. So some of the things I mentioned before, like real estate, private equity, venture capital, securitized artwork, we even support crypto on the platform. Self-directed IRAs give you the control to invest in things that have not been approved by a brokerage platform. So it really gives you the full control to deploy your retirement dollars into opportunities that are not correlated with public markets. Some of the reasons they haven't been popular in the past, as mentioned, with a lot of the larger custodians that are household names these days, they're typically not allowed on the platform because those custodians do not extend the optionality to invest in alternatives on their platform. With other self-directed IRA custodians, in the past, what we've seen is that the process tends to be too complex or too expensive, or a combination of the two for investors to get up and running. Hence why Alto was started founded in 2015, publicly launched in 2018. Really what we did was to use technology in order to improve the process for investors, reduce cost, reduce friction, reduce a lot of the manual complexities involved with opening up an IRA so that the flow looks a little bit more like opening up a retirement account with one of the more well-known tech advanced custodians for standard IRA accounts. So getting into how that process actually looks, first off, we run KYC on all investors on the platform, essentially making sure that everyone that we're supporting to open up a self-directed IRA account is passing our KYC, which is know your customer requirements. From there, we're pushing investors into creating their IRA account. Again, I mentioned earlier that we support crypto on the platform. We do have the Alto IRA as well, which is just more general alternative investments that you're able to make. The three that we support are traditional Roth and SEP IRAs on the platform, which we outlined a little bit earlier. So once an investor is electing which type of retirement account they're looking to open, at this point, they'll come through, e-sign their name, click create my Alto IRA. What we're doing in the background is that we're actually creating an IRA and opening up their retirement account in your name with our trust company, Alto Trust Company, which we fully own as one of our subsidiaries. Once the IRA is open, at this stage, you're able to start the transfer process. So we support a variety of different transfer methods, whether you're looking to make a cash contribution for the current year. With IRAs, it's a little bit unique because you can actually contribute all the way up until the tax deadline. So even for 2024, you can contribute up to April 15th to your retirement account for the 2024 year. So cash contributions can be made through the platform. You can also initiate a transfer from an active IRA that you have with another custodian. So if you're using one of the other custodians for stocks and bonds, what you can do is you can liquidate a portion of those holdings, initiate a transfer request through Alto's platform. That way the funds come over to Alto and you can self-direct those funds. And then the last option that we typically support are 401k rollovers from previous employers. Once you leave an employer, if you've ever done this in the past, you've probably seen the emails saying choose what to do essentially with your 401k. You can either keep it there or you can roll it over into a new IRA or an existing 401k that you have. Once you actually roll that over into an IRA, as alluded to before, you're given much more control with how you can actually invest those dollars. So we work with a number of investors who are looking to roll over the 401k because they have a large chunk of their net worth that they're looking to deploy to alternatives. In this example, we give a quick walkthrough if you are creating an IRA transfer. Essentially, the way that the process works with IRAs is that it's a pull request from your current custodian. Once you insert all of your custodian's information, it will generate a transfer of assets form. What Alto does in the background is that Alto will actually fax this transfer of assets form to the current custodian. It's a little bit unique of a fax situation because it's not an actual dial-up fax like you see in the or that you've known from the 80s and the 90s. It's actually electronic fax that all custodians use in order to process transfer requests. And then once the funds have been received to the Alto account, you're actually able to start making investments out of your IRA with Alto. So quick walkthrough, just outlining the process. We've tried to make it very simple so that investors can go through it step by step without falling out of the process. If you have a specific investment in mind, at this stage, you can make that investment, invite the issuer, execute subscription documents, and initiate funding for that specific investment. So now comes the question of why do you actually want to use your IRA to invest in alternatives? One is the tax-free growth of potential returns. Two is that 70% of investable assets are held within retirement accounts. So John, based on the slide that you showed earlier, it included the primary residence and the vehicle within that chart. What we're really looking at is the overall investable asset, anything from liquid assets all the way to retirement accounts, stocks, bonds, company stock, everything like that. We found that in our surveys that are published with the IRS and different sources, 70% of the average household's assets do live in retirement accounts. And then finally, the IRA account structure and rules align very well with alternative investment timelines and goals. It's a little bit harder to write a large check from your bank account, not knowing if you're going to need funds in the case of an emergency in 6 months' time or a year's time, just because the time horizon does tend to be a few years for alternatives. With the IRA, because most times people do not need access to those funds immediately, they're able to have more peace of mind when allocating to longer term projects. We cover this a little bit further in this slide as well, with a longer time horizon without being as concerned about those IRA dollars. Typically, people can't withdraw before the age of 59 and a half, as you're seeing younger investors on the platform who are using it in their 30s or their 40s. They're not as concerned with short-term fluctuations in the market within their retirement account. We also do find that alts have been historically resilient and are not quite correlated to the public markets, depending on the asset class. Again, this is no guarantee that things will remain the same in the future, but from our analysis and from what we've seen throughout the industry, a ton of successful startups like Uber, Airbnb, multiple other companies were founded during recessionary periods where they're not correlated to regular stock market investments that you can make through the retirement account. And then finally, the tax benefits of the IRA. As mentioned earlier, everything within the IRA is growing tax-free until you're actually taking a distribution. And this is, of course, just for traditional and SEP IRAs. Within the Roth IRA, everything is growing tax-free, even when you do take a distribution from that retirement account. So the tax benefits of alternatives do tend to outweigh the taxable effects of making an alternative investment if you're not using the retirement account in most cases. Getting into this, we see that ultra high net worth investors are actually allocating upwards of 50% of their liquid funds into alternatives, again, for a lot of the reasons that we just covered. But really what we see and this again relates to John's screenshot that he shared earlier in the presentation. Once you look at groups who are managing higher and higher volumes of money, we've looked at some of the college endowments of some of the Ivy League institutions, and I'll check my notes on this so that I quote it correctly. But when you look at Princeton University's endowment, they're allocated around 30% to private equity, 24% to hedge fund strategies, and around 18% to real assets, so real estate and other assets like that. Yale allocates around 90% of their endowment to foreign equity, private equity, hedge fund strategies, and real assets. And then once you look at Harvard's endowment, they're actually around 39% in private equity and around 31% in hedge fund strategies. What we see is that the more assets that are being managed, the more that are deployed into alternatives. We also show the broad realm of alternatives that can be held within an IRA: angel investments, venture capital, farmland, fine art. Typically, once you get into some of the more niche areas like fine art, a lot of those investments have to be securitized because you can't own a collectible directly. But that's just some of the things that we see within the alternative landscape and what we're dealing with at Alto. Using a real life example to show what are the tax benefits of making an investment through a self-directed IRA. At the top, we've got the Roth IRA, in the middle of the traditional IRA, and at the bottom, we've got an example of making a direct investment. There are some underlying assumptions that we've used to generate this graph based on your income rate at the time that you're taking the distribution or at the time that you're incurring the capital gains tax. But if you're making the investment out of the Roth, we used a $25,000 investment example that's worth $50,000 at the time of exit. With the capital gains tax, there's no taxable event because when you're making the investment through a Roth IRA, so all those funds are growing tax-free within the Roth IRA. So there's zero income tax, zero capital gains tax, and zero total taxes owed. Now, again, this only applies so long as you're not taking a distribution before the age of 59 and a half, because that would trigger an IRS early withdrawal penalty. Jumping into the traditional IRA, you can see that the cost basis, exit, and capital gain is the same. When the taxes are due for this is at the time you're taking a distribution from the retirement account itself. If I'm making an investment through my traditional IRA and I'm 40 years old when it realizes, I'm able to reinvest the full $50,000 immediately without paying capital gains taxes on that investment. If I was to take the withdrawal from the investment, I'm taxed at the capital gains amount for the full amount that I'm taking out of the IRA at the time based on my income rate. And then lastly, getting into a direct investment, you can see that the first three rows will remain the same. Taxes are actually due upon realization of the investment. So as soon as I'm realizing that investment, as soon as I'm getting the return of capital to my account is typically when my taxes are owed for that investment. We used a long-term capital gains tax rate of 20% for this assumption, showing that $5,000 in taxes would be owed due to capital gains taxes at the time of investment realization. So just to show some of the different scenarios, again, none of this is tax or legal advice, more for informational materials to help you understand what are the benefits of using a self-directed IRA to invest in alternatives. And then finally, recap, finishing up with some legendary self-directed IRA investors. Peter Thiel, commonly referred to in the IRA world as the Lord of the Roths, actually has around $5 billion within his Roth IRA. So he made a very early investment in PayPal, rolled part of that investment over into Facebook when Facebook was still private. One of the first outsiders to invest into Facebook's company. Right now, he's got around $5 billion or more within the Roth IRA. And because that's all sheltered within the Roth, none of that will ever be taxable so long as he's taking the distributions after 59.5. Max Levchin was another PayPal founder who used his Roth IRA to angel invest in Yelp. He sold some of those shares that he invested in 2004. When he sold in 2010, he made around $10.1 million in profit. Fast forward to 2012, he was sitting at around $95 million in shares of Yelp within his Roth IRA account. And then finally on this side, Ted Weschler, who was a Berkshire Hathaway deputy. Ted is a little bit unique because he started investing out of the traditional IRA. He actually filed a Roth conversion in 2012, paid an extraordinary amount of taxes to make that conversion, because when you're making the conversion, it is taxed at the income rate at the time of the conversion. You can elect typically to pay that either out of the IRA balance, or you can pay it outside of the IRA balance as part of your taxes for that year. Fast forward to 2018, his Roth IRA was valued at over $264 million by the end of the year. A lot of these numbers may seem like they're out of date, but this is not publicly reportable or verifiable. This is just what they've shared based on their financials and based on the investments that they've made. And then finally, just recapping with a couple of other notable Roth IRA holders, Randall Smith, who is the CIO of Alden Global Capital, which was a hedge fund. Warren Buffett has around $20 million within his Roth IRA, and Robert Mercer from Renaissance Technology with around $31.5 million in his Roth IRA. Really, the main purpose of sharing this is to show that even the most notable and famous investors are taking advantage of the IRA in order to make investments, primarily in alternative assets. But again, some of them are using the IRA to invest in publicly traded stocks, bonds, mutual funds, ETFs. And I think that covers most of the points. So appreciate everyone bearing with me as I covered all that.
Thanks, Dale. That was great. I do want to tie the two together because I'm the facilitator here. So we got Avery with the real estate project. It has three parts to it, as he described. And then we're doing a side-by-side offering, as I described, that allows anybody to invest. And then one of the options that people can have is to utilize what you just described, Dale, as the funding source to invest in a project like Avery's. Did I capture that right?
Yes, that's exactly correct.
Yeah, so that's why we wanted both these guys here today. And if you're watching this webinar, so there's a lot of a lot was said in the last 40 minutes or so, and a lot of us don't get this kind of information early on in life, and we follow the herd when it comes to what to do with our money. So whether it's investing in real estate development efforts or private placements in general, which we can all do now more so than ever before, and where we're going to get that money from, it's not taboo if you do it right and according to the rules to use retirement funds. A lot of people just write them off as something that can't be touched. That's part of why we're doing this webinar, is to try to educate folks that there are new ways of thinking about both these things. I do have one question for you, Dale. What can't you invest, or is there anything you can't do with retirement funds like you described?
Yeah, that's a great question that we typically see a lot of people asking, especially because a lot of people don't realize all the alternatives that they can invest in. Really, where it gets limited is that you can invest in things like life insurance, S corporations, because of the way that the corporation is filed and taxed. And then there's a handful of prohibited transactions, which I had alluded to earlier. So really where the IRS does not want investments to be made is anything that could be considered as paying yourself from your IRA personally. Hence why life insurance and S corps are typically prohibited from IRA investment. And then
Yeah, go ahead.
Sorry, one other thing that I forgot to mention, collectibles. I had mentioned that securitized fine art, wine, whiskey, things like that. Typically, if you're investing directly in the collectible, you're not able to. Once those items become securitized, where an LLC is actually owning them, that's typically where we see that you're able to own some of those niche and unique type of investments within the IRA.
Excellent. Good stuff. You don't have my picture on one of those 6 examples you gave. I was a little offended by that, but quick story. I ran a company for 17 years. I started up and I sold it in 2020. And along the way, one of the many rabbits I had to pull out of my hat to keep the thing alive was to use some of my retirement funds. Now, this is before you guys existed. So full disclosure, I didn't go through Alto, but I was able to legally, we were a C corporation. I was able to legally move some of my retirement funds and participate in an investment round. And when I sold the company in 2000, over half of the proceeds that I ended up with went back into my retirement account with all the benefits you described. And I like to joke, I had to get the smile surgically removed from my face after I found that out. So there's a lot of benefits to it. And I know firsthand how it works. And I appreciate you being here today to understand it. And also on our platform, Alto is integrated into our technology on our platform. So it's just another payment method following the process that Dale described. If anybody wants to use that as a source of funds. But thank you, Dale. Avery, do you have any questions for Dale?
No, I don't. Honestly, it was a really detailed presentation, and I've done a little homework in self-directed retirement products myself. I just need to execute. I've been more on the life insurance tip.
Yeah, that's interesting. Again, most people, unless they come from wealthy families like the ones on the slide, the last couple of slides, we don't learn about this stuff growing up, right? Because our families typically haven't done it, and oftentimes without getting exposed to this type of education, we're not aware of it. Hence, we never do it. So I appreciate you guys making the time today to help share the knowledge about this stuff, and I know firsthand how beneficial it can be. So I want to thank you. But anyway, that is it for our online event. Appreciate your interest if you're listening to this. If you have any questions, you can contact us at Folla Capital. Please visit our website, and you can also access the offering that we're talking about today with Management Continental Ground. And of course, you can visit Alto IRA. Their website's link on your console, or it will be in the YouTube comments. And it's an excellent option to explore. So thank you, gentlemen, and hope you have a great day.
Thank you.
Yeah, thank you for having me.